ESG has obviously gained an enormous amount of extra prominence over the last year or two, but in the main, good investment managers should have been incorporating most of the principles into how they manage money for people for many years. Governance, for example, has always been important because badly run companies are never sound investments. Companies which do things which are out of tune with society's general aims, or which are sticking to the letter of the law but not the spirit, that's being increasingly questioned, and quite rightly so. And more recently, over the last year or two, environmental concerns have come right up the agenda. So what we've been doing is, first of all, more formally structuring our engagement with managers, so that instead of just being part of our interrogation of their investment processes, there's a much more formal engagement with them on these specific issues. Our reaction is that we've been formalising our processes for talking to our managers about the degree to which they factor in risks from environmental concerns about oil companies, tobacco companies. Is it a good thing that people suffer health problems because of the product? And badly governed companies are something which we've never condoned people investing in. And over the significance of our having signed up to the UN Principles of Responsible Investing is that, first of all, we have to report publicly once a year to our investors on how we've engaged with our investment managers on these topics, and the UN PRI itself will give us a rating depending upon whether they think that we're up to scratch or not. And so that is in itself going to keep our own feet to the fire.